Okay, everybody, so welcome to the fourth quarter scouting report. I cannot believe that it's already the fourth quarter of this year. I feel like just yesterday we were starting the year. Here at Libertas Wealth Management Group, we are having a crazy, crazy year. It's crazy good, but it's crazy nonetheless. I'm just really, really busy, having a great year here in the office. Having a great year at home with my bride and boys. So I really couldn't ask for a whole lot more here other than for this market to start working with us a little bit. That would surely be nice. So today we are going over a little bit about, kind of what's gone on in the past this year so far. We're going to be talking about everything from stocks to bonds to gold and interest rates and indicators and seasonality and all kinds of nerdy stuff. But as always, I promise to make it as simple to understand as possible. And when I say as simple as possible, I think that most of you who think you probably wouldn't be able to get most of this stuff, I think that you probably would get most of it. So today I'm recording this. I'm asking you to bear with me. I just started recording at 11:39 at night. I would have preferred to do this at home, especially so late at night, but my sound card, my 14-year-old sound card in my music studio / home office at home crapped out on me, and I just bought a new one, and I have no idea how to use it. So it works, but only kinda. So we've got Tuesday, October 3rd is when we're recording this. Again, 11:39, just clicked over to 11:40 p.m. at this point. My name is Adam Koós. I am President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group in Columbus, Ohio. And again, this is the quarterly scouting report. So let's jump right into the meaty details, starting with a quote of the day. Bill Gates said, "Headlines, in a way, are what mislead you because bad news is a headline and gradual improvement is not." And I know I tend to beat headlines and news and financial news especially, I tend to beat them up a little bit, but I think they deserve it. I think oftentimes if you're paying attention to the news, the financial news specifically, magazines, the internet, that's even worse, it's probably going to tell you to do the wrong things at the wrong times. So I think it's important to look at real data, real information, and take that information, put it into a way that makes sense, so you can really understand what's going on with the market, understand whether it's a time to be conservative, a time to take some risk, or somewhere in between. And that's what we're going to do today. That's what we always do here. So I have to go over this cartoon because it's always so perfect. But with all this stuff we talk about with portfolio management, doesn't mean anything without a financial plan. And I mean that sincerely. Don't get me wrong. I love the markets. I love analyzing the markets. I love looking at charts. I could go through hundreds of charts and I wouldn't get bored. It's so much fun to look at all the different ways that the markets are behaving, how they interact with one another, and so on. It's just fascinating. But with that all being said, we have to have a plan. In other words, in order to know when we're going to quit working or when we can quit working, and if we're already done working, if we're already retired, knowing whether or not our money's going to last till the day we pass and beyond, we need to have a roadmap in place. It's like going on vacation. If you go to a travel agent or you talk to a consultant and you want to take a big trip and you say, "Look, looking to take a huge trip for my 40th anniversary and want you to help me get there." And then the travel agent says, "Okay, well, where do you want to go?" And you say, "Well, I'm not going to tell you that." So it's kind of hard for that travel agent to do their job if they don't know where you're going. And it's the same thing in the financial world. If we, as financial advisory, or as financial advisors, as financial planners, wealth managers, whatever you want to call us, if we don't know where you're going, and what I mean by that is when you'd like to have the choice to quit working or make work optional, how much you're going to spend for your fixed expenses, how often you're going to replace cars in retirement net after trade-in, how often you're going to go on big international trips and what you're going to spend on it, how often you're going to go on continental travel, call it weekend road trips even, so little trips, whether or not you're going to stay in the state, move to another state, have a second home, have a third home, whether or not you're going to downsize. All these are questions that have to go into a plan, because if we don't have a plan, then we're just investing and we're hoping we have enough. And last I checked, hope is not a good strategy. So I always have to start, this presentation here. I think last time I did this with this little cartoon, because up top here, this is not the market. It's not, we don't get a linear rate of return of 5, 4, 3, 6%, whatever, 6%, 6%, 6% every year. The average annual return for the stock market, looking at the S&P, going back the last 20 years, is just over 6% per year. And it's also been two of the worst decades in market history. Now, the 80s and 90s were two of the best decades in market history. What's the market going to deliver to us in the next 2 decades? I have no idea. But again, it's part of my job is to look at the markets for what they are, analyze all this data that's out there, and make sure that we're investing in what I call the playoff teams. In other words, staying invested in the best investments that are going to make the playoffs, that have winning records, are going through winning streaks and not losing streaks, and avoiding all the bad investments, the laggards, the teams that have no prayer of making the playoffs, and the teams that have losing streaks and losing records. So with that being said, let's talk about the stock market first today. That's what we did last time in the halftime update. And let's just go over all the asset classes. Just a quick asset class ranking here. You can see here on the right, our ranking system, long-term ranking system that is, has, believe it or not, and this kind of surprised me too, international stocks as the leader, the pole position here. So international stocks right now are ranked, excuse me, number 1, S&P 500. So that's domestic large cap stocks. That's number 2. Number 3, believe it or not, is money market, just treasury bills. And then in the basement below money market, you've got commodities, which are losers, small cap stocks, which we'll talk a little bit about later. And then, can you believe this? And if you've been watching any of our videos, reading our articles this past 2 years, you would know this already. But bonds, we were taught our whole lives that bonds are safe. That when markets go down, when stocks go down, we'll say when stock markets crash, that you gotta own some bonds to cushion the blow. And the truth is, with rates going up, that isn't the case. Rates go up, bonds go down. Rates go down, bonds go up. So it's not a matter of speculation. That's just how it is. So as rates have continued to go up this last 2 years, we have seen bonds get decimated. We're talking different areas of the bond market down 10, 20, 30, 40, 50% in the last 2+ years, almost 3 years at this point. So it's been rough, really, really rough for people who have, balanced portfolios or conservative portfolios and high allocations to bonds. And they have every right to be concerned if they've had bonds in their portfolio for the last couple of years. So that's where we are right now from a ranking standpoint. But I can tell you on a more, this is long term, on a more intermediate term basis, I can't agree with this, with this concept of international being better than the U.S. right now, and I'll explain why in a little bit. But first, I just want to this is called a zigzag indicator through Optima. I just thought it looked really interesting. So all it is just showing the different zigs and zags that have happened since late 2021, early 2022, and what a chop fest it's been. And speaking of a chop fest, let's look at small caps. Talk about, just absolutely disgusting. I just put yuck here because it's the first thing that came to mind. This is one of the biggest problems with the market. You've got big companies, that hold up the index, whether that's the NASDAQ, the Dow, the S&P 500, and those big companies carry most of the weight. Think of them like the generals. I like to use the analogy of the generals and the troops. There's a few big generals, and then there's tons of troops out there. And the troops that go into battle are your mid-cap stocks and your small-cap stocks and your micro-caps. These are the smaller companies. And as you can see here, just looking at this chart, going back to 2022, look at this peak up here in 2022, they just haven't been participating. So they haven't been going to battle. And in order for this market to really recover, and in order for us to see new all-time highs, we're going to need mid-cap stocks and small-cap stocks to start coming into the battlefield and joining the northward march upward. So that's something I've been paying attention to. Another thing I pointed out last quarter was how important the 200-day moving average is. And just to explain what the 200-day moving average is, all it is the average movement of any investment. It doesn't have to be the S&P, just is in this case the S&P. But it's the average movement of any investment over a 200-day period. So it kind of smooths things out. When we look at this candlestick chart right here, the S&P, you can see each candle is 1 day, and it goes back really, really far, all the way back to late 2021. But if all we do is smooth out the last 200 days, that's what you would call a simple moving average, or another way of thinking of it in simpler terms would be, say, a 200-day trend line would be another way of saying it. But the reason it's so important is because, an old quote from, I can't remember who said it, but nothing good happens below the 200-day moving average. And what that means is when you get below water here in this blue area, you can stay below water for a short period of time before coming up to air. But if the market stays below, or if any investment stays below that 200-day moving average for too long, it's your portfolio is going to drown in a sense. So here you can see in March of this year, the market, from February through March had a pretty bad dive, and then we finally found a higher low right there compared to this low. Things started getting better. And now we're kind of coming back down to that 200-day moving average again, as the market's gone down about 7 to 8% just in the last couple months. But just to show you some historic charts on why the 200-day moving average is important, here this is 2007 to 2009. This is the mortgage crisis. Again, nothing good happens below the 200-day moving average. It crosses below it, and the entire crash takes place underwater. Even after attempts here, and here to get back above that moving average, you could even argue it tried to get above it here, and it just couldn't. So that's 2007 to 2009. We've got here 2000 to 2002. This is the tech bubble. Again, breaks below the 200-day moving average, tries to reclaim it, and can't. Tries here in spring of summer 2001, tries again in early 2002, succeeds in April of 2002, but fails pretty quickly after just a few days, and then finally recovers in early 2003. But 2 years, below the 200-day moving average almost. We can look at other times, like 2010, where it went down and it spent some time below it. Here you can try to get above water here, try to get above water here, but couldn't get above it, and finally crossed back above it, and we were off to the races. Here's another example in 2011. Similar thing happened. U.S. Treasury downgrade happened in August of that year. Market goes down, kind of a double bottom here, tries to get above the 200-day moving average, fails again, tries again, fails again, and then we're off to the races after that. And you can see over here on the right, in 2012, how the market held that 200-day moving average and continued northward thereafter. So the 200-day moving average is important. One more, this is 2015 and 16, really, really tough time in the market back in those days. This was, 2015 to present's been pretty tough in general when you look at all the whipsaws, and this is a perfect example of two of them, where the market goes down about 12.6%, double bottom, tries to get above it again, doesn't even print a new high. We get a lower high, and then the market goes down over 14%, another double bottom, and then it finds its way above it. Here's the 2016 election right there. Market bottoms, heads higher, and then it's off to the races finally. But this is 20 months. 20 months of sideways action. No fun at all. Here's another quick long-term indicator. So the 13-week moving average is in blue, and the 34-week moving average is in red. So just keep in mind 34 weeks is longer, obviously, so it's going to be smoother, and it's going to take more to make it move. And the 13-week moving average is obviously faster. Each candlestick here is 1 week. And what this is doing is it's smoothing out the last 13 weeks in blue, and it's smoothing out the last 34 weeks in red. Where trouble starts to happen is when this blue line crosses below the red line. Right now, it's curling down. We never want to anticipate. We never want to say, oh, it's going to, so let's front run it. What we want to do is we want to follow the signals. So this is just, and by the way, speaking of signals, we don't want to sell everything in our portfolio just because one indicator goes negative, by the way. So just because this blue line went below the red line wouldn't be a reason to sell everything we possibly own in our portfolio. If we own investments that are going up, they have their own trend with no regard to the market. So if we're investing in the playoff teams, like I was saying earlier, and we own good investments, whether that's ETFs, so baskets of stocks, baskets of bonds, commodities, currencies, If we own even money market instruments right now, which are paying like 5.4%, which is incredible. I think it could be the first time in my 22-year career that I've seen numbers like that. But the point is just because we see one indicator on one major market index turn negative doesn't mean we should go ultra conservative and run for the fences. A friend of mine, Frank Capillari, put this out. I wanted to share it with you. I'm not a huge Fibonacci fan. In other words, Fibonacci extensions, which are based on rabbit reproduction. This is true, by the way. Fibonacci numbers are based on rabbit reproduction. I'm also not a huge fan of diagonal trend lines. I think they're too subjective. I like using horizontal lines of support and resistance personally. But the reason I liked this chart was because of the confluence or convergence of different things that are all happening at once here. So this is the S&P 500 pretty much just this year. You can see here we've got a high in February, a high in May that the market tried to contend with. It was unable to get above that point until June. It cracked above it in June. Since then it's pulled back, and we pulled back to that level. However, what makes this really interesting, this chart, is that it's not only pulled back to that level, which for me would be, again, a horizontal line, call it a floor of potential support below our feet, what the market should hold, and if it doesn't, that's bad news. But we've also got the 200-day moving average right here. So we've got that the line of support, the 200-day moving average. You look at this diagonal trend line. We have that trend line, which is an additional, more manually drawn trend, and then we have the 38.2% extension off the highs, which is the first Fibonacci line in the sand here. And all of those things are happening at once, which makes this level, like I said, a point of convergence that I think is pretty important. And the market should hold this level, I guess is what I'm saying. And what I mean by that is when I say it should hold, I'm just saying that I'm not saying it's going to, I guess is what I'm saying. I'm saying that it should hold based on the fact that we're in a positive trend. We've got higher highs and higher lows on an intermediate term basis. You could argue that this is a lower high and this is a lower low. Intermediate term, you could, and say we're in a downtrend now. But for me, the long-term trend is still up. But if we were to break all these lines here, then that would start to, I'd start really looking at this thing and this market as to whether or not we're in an uptrend on a long-term basis at all. So it might kind of, these levels right here, if broken, we're going to find ourselves out of what I call the caution zone and in the danger zone. And speaking of that, this is my inverse traffic light chart that I put out every month to our clients. I'll sometimes post it on Twitter and other social media. But as long as we're in this green area here, which is basically above the summer 2021 highs, and then the retest right here this summer of those highs, then I think we're in the green, and I think green is go, green's good. We're in this caution area again, which again not only is represented by these highs here as we go back in time, just like on Frank's chart, or just like we saw on Frank's chart, but we've also got the 200-day moving average, which is not pictured here, but below that level, I'm thinking a lot of trends are going to start breaking down, and it's going to be time to start in our tactical models. We have two types of models at our office. We have strategic models that stay in the market all the time and stay invested in those playoff teams and avoid all the bad, laggards. And then we have tactical portfolio models that do the same thing, but they also have a second filter, which essentially when the market's going down on an absolute basis, or any investment inside the portfolio is going down on an absolute basis, that we would actually sell it and go to cash. So in the strategic models, we're going to own the highest relative performers on a certain look-back basis using proprietary formula. In the tactical trend-following models, we're also going to own the highest relative strength investments, but it doesn't matter if it's the best investment in the world. In the tactical trend-following models, if it starts going down too much below a certain line in the sand, then we're just going to cut bait and wait for a better day. So lots of different portfolio models here. I don't want to get into it on this screencast, but I just wanted to make sure I'm being clear when I talk about the danger zone. I want to make sure I'm being clear and not saying that we'd be selling everything. That's not how this works. Last couple things here, just before I get into sectors and individual stocks to highlight, is the tug of war, if you will, between U.S. stocks and international stocks. This is a chart, it's called a relative strength chart. And what it's doing is it's comparing the S&P 500, so U.S. stocks here, large cap U.S. stocks, to stocks overseas ex-US, meaning all the stocks overseas, but not including the US stocks. So when you look at this chart, what you're seeing here is I put a moving average on it, a 50-day moving average, just to kind of smooth things out. And basically, whenever the trend is up, or whenever this line here is above that 50-day moving average and sloping up, or the trend is up, then that means U.S. stocks are outperforming international stocks. And the best place to be is in the U.S. Whenever it's below that line or trending down, like these little boxes I've created, that means international is outpacing the U.S. What's really interesting about this is that the U.S. dollar has a lot to do with this. So when the dollar starts to struggle, that makes international investments attractive because the dollar goes down in value, making international currencies go up. So it makes those stocks go up, essentially. But what's interesting here is that for the first time in 14 years, we started seeing the biggest drop in this relative strength comparison. So in other words, it was the biggest potential shift that was suggesting perhaps international stocks were going to finally start outperforming the U.S. for the first time in 14 years. And then all of a sudden, the U.S. dollar started strengthening again, and it's been going on a tear. And here we are right back above that 50-day moving average, and the U.S. is the place to be again. So we had a pretty heavy allocation to international stocks earlier this year. We've cut back on that allocation to international and made it a smaller percentage. And at some point here in the not too distant future, if this thing doesn't improve, we might not own any international stocks anymore, or at least very, very little. But right now we're underweighted. But if I wanted to show you though, going back that 14-year period, these are all the only 5 times where international has even remotely significantly tried to overtake U.S. stocks and try to outperform. You have to go back to 2003, 2004, 2005, 2006, 2007, 2008. That time period was the last time international stocks outperformed, which is just fascinating. It's kind of crazy when you think about it. But at some point, there will be a point in the future when there is it's better to be someplace else other than the U.S. And we're just going to have to kind of wait and see when that might be. So let's change gears and talk about some sectors and stocks. The first ones I want to share with you are the good sectors, basically. The ones that I'm paying attention to that I like. So the first one, and one of the best, is semiconductors. There's a lot of AI, in these investments, like NVIDIA. It's been in the news a lot. So NVIDIA is a semiconductor stock, AMD, and so on. So they've been really holding in there while the market's been going down and printing lower highs and lower lows. And you can see barely a lower high and a lower low here. But the semiconductors have been holding up better than the overall market. Similarly speaking, technology overall, which obviously semiconductors are part of the technology index, but technology has been performing better than the overall market. And what I like about this is that it's really hard for anybody to try and convince me that this market's going to crash if technology is doing well and outperforming the market, if semiconductors are outperforming the market. It'd be different if we saw defensive sectors outperforming and doing well, but that's not what we're seeing here. As I show you the next couple here, this is energy. So think oil stocks, energy stocks. We have a high back here in November of 2022, and then it tried to break north of that high again here just recently and was not able to do so. We still do have an intermediate term positive trend right now in the energy sector, so it still looks good. It's on a relative basis, or a relative strength basis. It still looks good right now, but it's going to take some work in order for this thing to break above $94 on the XLE, which would obviously prove that things are going to continue to get better. And then the last good one here I wanted to show you with is kind of on the brink of breaking down, just like the overall market. In fact, this looks a lot like the S&P 500 now that I think about it. But we have these summer highs from 2022. You can see how it broke out. This is discretionaries, by the way. So luxury goods, things we like that we want. These aren't needs, these are wants. So discretionaries, when they're doing well, that's good for the market because it means people are taking risk. They're spending money on luxuries, things they don't necessarily need, but they just want. So here's a breakout, but it was a failed breakout. Here's another tiny one-day breakout, but it was a failed breakout. So now we're sitting here contending with the first quarter highs on the XLY, or the discretionary index, and it's holding that line right now, but we're going to have to see what happens here over the course of the next few days and weeks, and if it can hold and head kind of maybe chop in a range sideways here before heading higher, or if it ends up breaking down, that wouldn't be good, obviously. But all that's relatively good news, and so is this. This is going to seem strange that this is good news, but consumer staples. Staples are the opposite of discretionaries. They're things we need. They're things like razors, soap. It's when the market's not doing well, you typically see the staples do well. And the reason for that is because people tend to spend their money on the things they need, and not really and not be frivolous with their money on luxury items. And what we're seeing here, partially due to rising rates, because some of these are high dividend payers, and people are going for high rates and fixed income investments instead of dividend paying stocks. But you can see here, staples just being taken to cleaners, and this is a defensive position. And I think that if the market were in danger of a huge crash, then we'd see this doing well, not a cascade. Here's another one similar. Again, another defensive position. This is utilities. Utilities usually pay high dividends. Again, these are being affected by interest rates going up, of course, so people don't care so much about the utility dividends when they can get higher rates on lesser risky investments. But still, all that being said, if this market were in danger of crashing, you'd see positions like utilities doing well, not getting crushed like they are. Got one more for you here. This is healthcare. This is another defensive position. So a defensive sector. When the market is doing poorly, defensive sectors do better, and we're not seeing that. We're just seeing choppiness in the case of the healthcare sector at best. In fact, it's in the healthcare sector is in the same place it was in mid 2022. It's going nowhere. So I look at this stuff as almost like the weight of the evidence. I want to compare everything. Look at everything as one big huge picture. Think of it like a T-chart, pros and cons, good and bad, and then you tally it all up, and you take the weight of the evidence and you look at the market for what it is. Again, that's as opposed to looking at headlines or using one indicator and saying, if this happens, I'm selling everything. Watching the news, right? So anyway, let me change gears here. Just want to talk about a handful of stocks. The stocks, full disclosure, the stocks that I'm discussing here are stocks that we own. So I want to share that. And I purposely share ones we've owned for a while because I don't want to encourage people to watch these videos and do any sort of short-term trading. So obviously, a quick disclosure, past performance is no indication of future performance. You cannot buy any of these investments and assume we're going to own them next week, let alone tomorrow. We could sell any of these investments at any time, so I just want to make sure that you understand that. So Cadence Design Systems is a stock we've liked for a while. When I say we, I guess I. And it's gone really, really well. Meta, Facebook, in other words, has also been a great stock for a while here. Another one I really like, NVIDIA. We talked about them a little bit earlier. NVIDIA has been very much heavy into the AI space, and it continues to just surprise everyone that it keeps going up. Here's a big, huge gap up right there. People might think, I'm going to sell that thing and sell that gap, and thinking it's going to come back down. But really, it's just slow and steady, but it's continued to go up, and it's continued to outperform the market overall. Another one I like, Palo Alto Networks. It's a little bit choppier, a little bit more volatile, as you can see here. You got a gap down, then a gap back up again. So, recently it hasn't gone anywhere in the past few months, but still on a relative basis, a great stock. And then last but not least, more of a blue chip, Caterpillar. Not nearly as exciting. Everybody knows what Caterpillar is, heavy equipment. Lots of building going on out there. Population's going up. People are building, and they need the trucks to do it. Of course, if we could just find the employees, right? If we could just find good work in the labor market, which has been tough to do in the construction industry. So that's a look at some sectors and individual stocks. Let's change gears and talk about the bond market, which is really these days just as interesting as the stock market. First thing I want to show you real briefly is a screenshot of a relative rotation graph. What this is think of the middle as the S&P 500, so it's our benchmark. Upper left quadrant would mean if the investment's in the upper left-hand quadrant, it's improving versus the market. Upper right would be leading or beating the market. Lower right would be weakening versus the market. And then lower left would be lagging. So when we look at all the different sectors that are out there compared to the S&P 500, you can see the NASDAQ's kind of coming out of the leading quadrant, and it's been weakening, pointing toward the lagging quadrant. So NASDAQ hasn't been doing so well lately. That's no surprise. But some of the surprises here is that commodities have come out of the improving quadrant into leading, so commodities have been doing well lately. Every one of these dots is 1 week, by the way. You can see T-bills here, so this is essentially money markets have come out of the lagging quadrant into improving, and they're basically essentially improving, not quite outperforming, but improving and outperforming the market, meaning the S&P 500. The Dow has been improving versus the S&P, and then the last two here, international stocks have been improving versus the S&P, and this one's the one that's most interesting. You can see here that bonds, long-term, so 20-year treasuries, are starting to finally point northeast toward that improving quadrant. And not only that, but it's the further away from center we are, the bigger the movement in the investment in question. So all this is really interesting to hear, is to kind of see how things are going. So at some point, I'd like to think that that bonds are going to bottom, and I don't know when that's going to be exactly, but it's something I'm watching very closely, literally almost daily. All right. Nothing pretty to show you with bonds. This is just a 1 year chart. I mean, I don't want to. If I show you a 3 year chart, it's ugly. Like I mentioned earlier, depending on the sector you're looking at within the bond market, bonds are down anywhere between 15 to 20% on the low end, to as much as 50% or more. So it's ugly. And then just this year so far, that I drew this line here in the sand at the year-to-date mark all the way over here. So bond market as an aggregate's down 5.3% this year. So bonds are losing money again, or I should say still losing money. This is the 10-year yield. So the 10-year note. This is not the bond. This is the note. So it's the yield. And because we're looking at the 10-year, this has a tendency to have a very high correlation with mortgage rates as well, by the way. So the reason I want to show you this is that, again, just all summer, rates just kind of have steadily climbed. And as those rates climb, not only do mortgage rates go up, but bonds go down. And here's the kicker. Here's our 20-year treasuries. If you look back to the quarterly scouting report from second quarter, or the halftime update, I was watching this thing like a hawk. In fact, I took a trade right here. In other words, we went in for the first time in more than a year and a half at that point, and we invested our money in bonds. We went all into the bond market, held it. It popped here for a few days, and then it broke down, and we ended up selling it when it crossed below this red line in the sand here. So it didn't make any sense. Great risk-reward trade, meaning our risk was very low. There wasn't much we could lose as long as we sold when it cracked below this line, and our reward could be very high. It was a very high potential reward because the risk was so small. But at the end of the day, it failed, and all that matters now is that we protect our money. When trends don't work out and the analysis says it should hold this line in the sand and it doesn't, that's where you have to be nimble and you have to walk away. So you can see here year to date, if I go all the way back to January of this year, the 20-year treasuries, so 20-year U.S. Treasury bonds, down 14.5%. Again, pretty ugly. Let's talk about gold and the U.S. dollar here briefly. So I'll just go over each chart once is all. Something that's going to be a big headline here pretty soon, assuming it takes place, which it looks like it's going to, is we're about to see a death cross in gold. What that is it's when the 50-day moving average, so the 50-day trend line in blue here, crosses below the 200-day trend line. It's kind of in the technical analysis world, it's I'll call it a stereotype that when the blue line crosses below the red line, that's called a death cross, meaning bad things are to come. And then when the blue line crosses above the red line, like it did back here in early 2023, that's called a golden cross. In other words, it says that there's possibly good things to come thereafter. So while we did see a golden cross just 10 months ago, is all that positive trend. If we just use this one indicator and this one, these two moving averages, and that's it in our analysis, not looking so good right now. So we'll have to see what happens here in the next few days and if this cross takes place. But unless gold turns around real fast, unless we start seeing higher prices really soon, we're probably going to see that death cross, and you're going to see it all over the news. When we look at the U.S. dollar, which is really, really important for a number of reasons, when the U.S. dollar goes up, one type of investment that struggles is gold. We just looked at gold and how it's struggling. Another thing that happens when U.S. dollar goes up is international markets struggle. I put in a little note here, when the U.S. dollar falls, international markets do well because obviously the U.S. dollar is going down, foreign currency is going up, and that makes those stocks do well, relatively speaking. But what we've seen here is this little bear trap. So we have a low here, another low here, and what was going to be a triple bottom. In the end, ended up being a triple bottom, crossed below that line in the sand. A lot of analysts back then, myself included, were thinking, okay, this could be it. We could see a big drop in the dollar now, and international investments could really start to outperform. But that's not what happened. Instead, we ended up with a bear trap, which just simply means that the bears thought it was going to crash and it didn't happen, and now it's back above that line, and not only back above that line, but back above this line in the sand back here in spring of this year, which kind of completes the pattern actually. So right now, again, this also is telling us that the U.S. is the place to be and where to have our focus, and gold going to struggle. With interest rates going up, the dollar going up, inflation kind of slowing down. That's not good for gold either. If we finish up talking about some market indicators and seasonality, first thing here, this is from Bespoke. I just thought this was interesting when you look at the Russell 2000. So all the small caps out there, all the small cap stocks in the Russell 2000 index, this is the percentage below their 52-week high. And this, again, goes back to where the troops have to participate. We need the troops, the small caps and mid caps, to go to battle in order for this market to really get some steam. And right now, when you look at healthcare, down 45.8% below its 52-week moving average, below its 52-week high, that's not good. 21.3% on energy, that's not. It's just we need more traction out of those small cap stocks. Speaking of moving averages, I got ahead of myself here. So while the stock market's down, you can see a low here, lower high, another lower low in the S&P. This lower pane right here is the percentage of stocks in the S&P. So remember, the S&P 500 is just over 500 stocks on the market, and some of those are large caps, some are mid caps, some are small caps. And you can see only 12% of stocks in the S&P are actually above their 50-day trend line or 50-day moving average, which is not really a healthy number. Again, we need that number to come up, and we need to see more participation of all of the stocks, or at least most of them, within the S&P to get this trend turned around and continue higher. A little bit longer indicator here is the percentage of stocks on the S&P 500 above their 200-day moving average or 200-day trend line. You can see here 38% of stocks within the S&P 500 are above their 200-day trend line. And, that's kind of a weak number. We want to see that getting better here. But the good news is it's holding this line in the sand back here and back here. So that's good. So, I guess call it a consolation prize. This is from Katie Greif. She just pointed out, which, I was too lazy to put the chart together, I guess, that September was the worst month of the year. Really kind of a rough late summer for the market here. So this is just kind of an FYI. We're coming out of a rough summer. And then this is really interesting. I can't remember what chart, who made this chart. I did pull it on Twitter. But this is the number of months when a 5% or more pullback have ended. So think of it like a pullback or a market correction, the number of times when a drop of 5% or more stopped and the market started recovering. And when you go all the way back to 1945, 33 of those market bottoms took place in October. So October has a tendency to be a time when markets do bottom, not just in when it comes to big long-term trends, like market crashes, like the tech bubble and so on, but in shorter term, market pullbacks and corrections. And what I want to show you here, so this kind of parlays and builds on top of that high number of occasions when the market's bottomed in October. You can also see, September, seasonally speaking, is the worst month of the year for stocks, going back to 1950. October is a good month typically, and then November and December tend to be really, really good. So you can see here the best month of the year on average November, second best month April, third best December, and then October's up there. It's not, you can see January, March are still better, but it's a good month. So I think that there's a lot of evidence here suggesting that things could be getting better. This is the 4-year presidential election cycle. I know we're all anxious and excited about all the political ads that are going to start coming out, all the local issues that we can argue about at social gatherings when we should just be having fun with one another. I'm obviously being sarcastic. But you can see here the averages, these dotted lines are the averages going back to 1949. And you can see between the NASDAQ Dow and the S&P 500, obviously the NASDAQ tends to outperform here. There tends to be this sideways movement into the pre-election year finish. And then in the fourth quarter, last 2 months of the year, we start to see a rise. And then in election years, there's kind of just a steady rise into the end of the year. And that's I'm going to speculate and say my opinion is that the reason why markets have a tendency to be pretty steady in election years is because there isn't a president, Democrat or Republican, that wants the market to go down when they're trying to get reelected. So we always have to keep that in mind. Last but not least here, when we look at, this is just another way of looking at the market seasonality. Since 1950, you can see that October, November, December, a good 3 months here for the market. When you look at the past 20 years, again, a good 3 months in blue there. The last 10 years look really good in October, November. Not as good in December, but October and November look really, really well. And then pre-election years, which is what we're living in right now, is a pre-election year. October tends to be up a little bit, November up a little bit more, and then December tends to be a really good month for the market in pre-election years. So with that all being said, I thank you for taking the time to watch this video. I managed to get this done a lot faster than I normally do because it is now 12:20, so it's after midnight. I'm going to go ahead and close this thing out, and if you have any questions at all about this presentation, any of the charts that were shared, if you'd like any of the charts, feel free to reach out and let me know. If you'd like a second opinion on your investment portfolio or your financial plan, or better yet, if you don't have a financial plan or a retirement plan, you need one. So if you'd like one, reach out to us so we can schedule an intro call, about a 30-minute intro call just to get to know you a little bit better, understand our process, and then we can kind of open it up for questions and see whether or not you'd like to go through the process of our financial planning process, or second opinion process, as we like to call it. You can get a hold of us on Instagram. I'm at Adam Koós. We're on Facebook at facebook.com/Libertas Wealth. You can find me on LinkedIn as well. I'm on Twitter at Adam Koós as well. That's Adam, Koos. And of course, you can always email us at info@libertaswealth.com. Or if you have questions or want to do a little bit of research, you can always go to libertaswealth.com if you want to set up an intro call. And you can click on a little button that says "Click here to find out more." Click here to find out if we're a fit. There's a couple buttons you can click to set up an intro call with us. So, with that all being said, hopefully you enjoyed this presentation. Hopefully you got a couple good golden nuggets out of it. But I wish you the best for the fourth quarter of the year. Let's all join hands and wish the market up, and hope that we see a really, really strong quarter. Otherwise, enjoy the fall weather, enjoy the football season, enjoy fire pits outside with your family, long walks in the brisk fall, autumn weather. Have a wonderful holiday season, and we'll talk to you on the next screencast when it's time for Market Outlook 2024.